Good afternoon. My name is Ken Scornia, President and CEO of Krilogy, and I'm here with my partner, John MacArthur, our Chief Investment Officer here at Krilogy. And this is your July market perspective, but it's actually August 9th. It's the first full trading week in August, John, and it's been a wild one. Markets have been sort of bouncing all over the place. S&P 500 almost down almost 10%. NASDAQ even further. Even individual companies like NVIDIA down 30+%. So it's been a wild ride for the first week here in August. But something we actually predicted a few videos ago, which was we can't predict up or down, but we can predict some volatility. Here we have it. What's your thoughts?
Plenty to talk about. Yeah, interestingly, in our weekend memo this weekend, we said, welcome to the growth scare. And it's certainly been that. Outside of the Japanese yen carry trade situation, which we won't get into that nuance today, we're really at that phase where we've seen hyperbolic growth, price appreciation in markets broadly speaking. And this is the phase where the issues around slowing growth are greater than issues around inflationary pressures. The Fed is winning the battle on inflation for now. We think it's a longer term secular story. And so while the battle has been won, the war isn't over. We think it's a multi-year issue potentially. But, I think it's important to focus on fundamentals. Yes, the economy is slowing. It's frankly a healthy reset for markets. But if we look at Atlanta now GDP forecasts, in terms of GDP growth, we're at about 2.9% annually. If we look at other measures such as ISM services index, consumers are still spending. That's in an expansionary, territory. Retail sales is firm. And then really earnings have been quite decent.
Yeah,
I won't say great, but they're not bad.
That's right.
And, 12% year-over-year earnings growth, and just as recent as the end of June, the expectation was less than 9. So,
and the markets have been a lot about large cap tech, right? I mean, they've been the leaders for quite some time. Midsummer, we would start to see some broadening of the returns throughout the mid and small caps, even international. And then we hit this volatility moment here where large tech really took turn the other way, started to come backwards. And I think what's interesting is, when you look at the S&P 500 returns, it's just been almost straight up for quite some time. Now we're getting to these moments where, I think you said it, how do you continue to grow? How do you continue to get the returns in a market that's not going to just easily give you sort of Goldilocks returns, right?
Right. It's an excellent point. The market has really been straight up. I mean, for perspective, we're about 15%, or the market within the last week or so had been 15% away from its 200-day moving average, which is a longer-term trend measure. And that's quite extended. The market regularly checks back to the 200-day moving average. That would be 15% lower. We saw a peak decline, as you mentioned, a little bit less than 10. For reference, that would be 4,800 on the S&P. Now, I'm not suggesting we have to get there. We may get there later this fall. Pre-election jitters are quite common, going into a seasonal period where September and October are more volatile even than what we've seen. So, that's certainly possible. But again, we would anchor back to the fundamental story. The bar for large cap tech has been set so high, and it's really, price has led phenomenal earnings growth over the last couple of years. We're now getting to that point where that bar is set really high. And if you look elsewhere into the other 495 or 493 companies in the S&P, we're seeing accelerating earnings growth there. It doesn't have to be great, but if it's better, that helps price where valuations are lower, frankly.
And I was having a conversation, you and I, you run the money, I run the company, right? That sort of, and we do this in tandem. But we also sit in many client meetings. We are hands-on with our clients and our advisors and making sure that we're understanding where the clients are with their wealth, their portfolios. And I was having a conversation with a client the other day, and I think, they asked, what do you feel like when the market drops 1,000, 2,000 points as a leader in the organization? What's interesting is I feel opportunity. because our trading team really gets to work on taking advantage of opportunities that you've set our portfolios up for some time. Sometimes are, we'll like you lengthen the duration on your bond portfolio for all bond portfolios, and that created huge opportunity for you over the course of the last few weeks. You even made a little bit of money on the yen trade in the Japanese yen, not in all portfolios, but then the little bit more tactical portfolios out there. And then, of course, just straight selling some gains and buying into some opportunities when markets get volatile. It's the power of a trading team and a research team.
Right. It's a good point. The payoff doesn't happen right away, so to speak. It's, as we know now more than ever in markets, risk happens fast, and with information flow and technology nowadays, moves are very quick and sharp, and either you're positioned for them or you're not. In our strategy, we like to marry kind of the fundamental quantitative research along with some technical analysis overlay. You referenced the Japanese yen positioning. Frankly, our Director of Technical Research, Jamie Setley, had us set up for that. And some of our models are more active models. July 23rd.
Is when he got into
long
it.
Japanese yen, and it worked out quite well. You mentioned lengthening duration. Again, we kind of had this long slug of intermediate to long-term rates ping-ponging around until in yield terms, they fell hard and bonds rallied hard. And that's where you really capture meaningful gains in a quick period of time. And so, it's just staying disciplined to process and being thoughtful and proactive around, what appears to be coming down the head and assessing risk and return and those types of things. So,
what are you seeing out there in terms of clients? They're nervous, they're scared, pretty confident?
Yeah, I think with the expected Fed cut for the first time in September, which looks very probable at this point, I think the realization for folks that, okay, the money market, selling point over the past couple of years is becoming less enticing as they're very sensitive to a decline in short-term rates. So it's a reassessment of fixed income positioning. It's been a tough place to be, broadly speaking, in bonds, but we think it's already become better, and we think that continues. So. I think recognizing the opportunity diversely in fixed income. Again, prior to this volatility bout that we've seen recently in most risk assets, small cap had significant outperformance relative to tech. That's come down quite a bit as we contemplate how slow is the economy growing. Are we rolling into recession? Or not, but we think that normalizes, and we continue to think that, again, with profitable small cap, I'll mention that caveat.
That's right.
There's segments outside across markets broadly that continue to make a lot of sense for diversification purposes.
And then 2 questions, and then your final thoughts. International, what are you thinking on the international side?
Yeah, the international space has been tough, as we've talked about in prior conversations, for a long time, most of this cycle going back 10 years plus. Valuations have come down. That's not in and of itself reason to consider. I think you've got some currency tailwind benefits over time as the US dollar weakens, the Fed starts cutting. And then you're seeing a little bit better earnings growth there. So I think it's a key part of most portfolios. It's not something we're overly aggressive, but we're definitely participating. That's important.
And then just give us your final thoughts on portfolio construction, and then I'll leave with my final message.
Diversification, again, it's an age-old advice, but it's really important right here, particularly with the volatility that we're seeing. I think pay attention to the fundamentals. As we go forward, there's going to be a lot of noise continued in the financial media. There'll be election talk, et cetera. But just stick to discipline, stick to being diversified, and you'll be fine over the long haul.
Discipline, that's where I was going to touch base on. I think that, when you get opportunities like this, when the market, gets volatile, just understand that there's a couple of things we do. I actually wrote an article 4 years ago when the market dropped dramatically during the COVID pandemic. It dropped 1,000 points, then it dropped 3,000 points, then it dropped 7,000 points. I wrote 3 of the articles with the exact same items in there, and there was just, what does a CEO of a firm do with his portfolio when the market drops? And there's just a few fundamentals you need to think about. Number one is make sure you understand how much cash you need at any point in time. Number two is make sure you understand what the goal of your portfolio is. Is it long-term growth? Is it short-term growth? And make sure that your portfolio is allocated to that specific risk portion. And then the final one is talk to your advisor. Talk to the person helping you with managing your money to make sure that you are both on the same page. Because if there's opportunities to be had when the market drops, take advantage of them. But if there's opportunities for you to take some risk off the table, you might want to think about that as well. It all comes down to your personal situation and where you are in your personal wealth plan. Well, that's it for our July market perspective. For John MacArthur, I'm Kent Scornia. As always, we appreciate you allowing us to be stewards of your wealth. Thank you very much and have a wonderful day.